Thanks for joining us here on Market Call. I'm Morella Fernandez. David Driscoll is on the show today. Founder, President, CEO, and Chief Investment Officer at Liberty International Investment Management. He's taking your questions today on global equities. Here is how to reach us toll free, 1-855-326-6266 if you'd like to phone us. If you want to send an email question in, you can send that to marketcall@bnnbloomberg.ca. David, thanks for coming in today. A quieter, steadier day on the North American markets. We are happy with that so far today. You've said investors have been chasing unicorns for a while. Can you explain that and also why you say the mentality has now changed?
When you have what's known as a risk-on market, it gets to be a very crowded trade where there are only, last year there's a Magnificent Seven where if you owned them, then you made the S&P returns. If you didn't own them, the S&P 500 or the 493 were only up 2%. So you see a lot of risk being taken without a lot of insight as to what could happen if February and March introduced trade tariffs. And now we go from risk on, which we've pretty much seen for the last 2.5 years, to risk off, where Europe is up, the United States is down, because hedge funds move money out of AI stocks into stocks that are deemed to be cheaper. The euro has risen 4% against the US dollar. The US dollar has fallen. Emerging markets are up. Europe is up. Pretty much everything is down. So everybody is running for cover. So they buy bonds. They may buy preferred shares because GIC refugees are seeing reinvestment risk at 2.7. Preferreds are yielding about 5%. So you see everybody wanting to go hide, run for cover, and that's when diversification works because you're not piled in with all your eggs in one basket. Now you go the opposite way where the volatility through diversification is reduced and therefore you don't fall as much as what the Magnificent Seven are down this year.
So looking for more of a balance. When was the last time you saw something like this happen where people went sort of all in a really rising trend and then had to back off?
Well, 1999, 2000, that was the burst of the internet bubble. But we've also seen these types of markets with high volatility in 2011 during the Euro debt crisis, when Greece was making headlines all the time, and 2018 when Trump tried a trade war against China. And interest rates, if they're going up, is going to hurt growth stocks, which are tech stocks and small caps, and pretty much put a ceiling on the US dollar. So year to date, the US dollar is down about 4% against a basket of international currencies, which is why the emerging market stocks have gone up.
You mentioned diversification is probably a better way to go right now, a little bit more balance people are looking for. Diversify into what? Where should people be looking at this point? We'll talk more about topics later, but just generally.
Generally, it's important that people are diversified, not just in North America, but outside. We've seen the drop in the Canadian dollar, so rising currencies of others helps protect your portfolio, and not to be correlated. So it's the correlated investments that can hammer you, where you can go up 100% one year and then drop 70% the next, and your net is at 60 cents, not at $1. So think about the AI stocks over the last 3 years. You're taking on 3 times the risks, so you get 3 times the reward. Or in 2022, when they fell as much as they did, you get 3 times the risk.
Got it. Okay, we do have to take a break so that we can line up some phone calls. David Driscoll is the founder, president, CEO, and CIO, Liberty International Investment Management. He's here to take your questions today on global equities. Here's how to reach us. We're back in a moment. Welcome back to Market Call. We have David Driscoll at the desk ready to take your questions. Our first one comes in an email from Bob. He wants to know thoughts on Banco Santander.
Well, both the large Spanish banks have done very well this year. They're up about 40 to 50%. And that's because you're getting higher tourism into the country, so people are spending more money. There's more diversification with both Banco Bilbao and Santander throughout the world, especially in Latin and South America. They are talking about leaving the UK as a threat against the high taxes and laws that the hoops they have to jump through. But when you look at the Spanish banks relative to the rest of the European banks, you're taking on 3 times as much risk, and that's because their non-performing assets are about 3% relative to 1% for the average.
Interesting. Okay.
So take it with a grain of salt that, yeah, it's having a great year, but it's coming off its lows. And if you look at longer-term performance, think back to 2011 during the debt crisis in Europe, and the Southern European stock markets were down quite a bit, especially the Spanish banks, because construction loans were a huge risk at the time. So, rule of thumb, and this is like dealing with the artificial intelligence stocks as well, double your money, sell half. These are not really long-term investments that are going to give you 10 and 20-year returns that are above average. So these are ones that you're going to have to trade as opposed to invest.
Got it. Okay, let's go to the phone lines. Greg's on the line calling from Toronto. Greg, what's your question today?
David, I'd like to hear your analysis and outlook for Novo Nordisk. Thank you.
Yep. The stock's down 17% this year, 42% over the last year. It looks like it went up too far too fast. On the way down, we've been buying more, and the reason is that obesity is not changing anytime soon, and therefore you're still going, you have 2 choices if you're obese. You're either going to die or you're going to end up taking Lilly or Novo's weight loss drugs. People are afraid of U.S. tariffs, but Novo already has manufacturing plants in the United States. They're not going to be facing that. Outside the United States, they do hold pretty much, they've got 60% of the revenues are outside North America. Eli Lilly's is 60% within the United States. So it's a little bit of a difference. They have more of the global market share. And concerns about other companies coming along and making quasi-Ozempic
Similar
drugs.
products, yeah.
Yeah. All you have to do as a pharmaceutical firm is change your formula every 3 years as you go off patent, and then you get to extend your patent protection longer.
That being said, do you think because they were first out the door with the drug and people get used to the name, they will continue to turn towards that? Doctors, I guess, will prescribe the same medication?
Yeah, from a branding perspective, it's always nice to be first out of the gate. There will be competition, but it's deemed to be a large multi-billion-dollar potential industry. So it allows them to continue to manufacture what they have, get production up to scale so that they can reach as much as the population as they can that need the drug. And in the meantime, what they're doing is spending a lot of money on research and development, using the same GLP-1 formulas for other diseases such as kidney or liver diseases. So it's almost like, I've owned this stock since 1990. So here we are 35 years later, and there will be dips in the stock where they do very well, then come down, go up, go down. But over time, it rises. And this is an opportunity for investors to buy the dip, because that's what we're doing right now.
Okay, let's move back to the phone lines. Taraver's on the line calling today. Hi, what's your question?
Hi, my question is on Coloplast, the Danish maker of, I believe, colostomy products. Mr. Driscoll, you've talked about this before, and I know they did 2 big acquisitions. How are those working out? I know it's been several months. What feeling are you getting that the free cash flow can be increased by this company? Thank you.
So Coloplast, I have at 729. Is that
Danish
sound
kroner.
right? Yeah. Okay.
So divide by 5, and it gives you kind of a Canadian dollar value.
Got it.
So free cash flows continue to rise. Revenue growth is still in the 6% range, and it'll range between 6 and 8%, which means that they've been able to make the acquisitions, bring them in-house, and see earnings accrue to the acquisition. They have plenty of cash. Debt payments have been made, which is reducing the debt outstanding, which is a good thing. And nothing has really changed for this stock, is that they continue to grow 2 to 3 times faster than GDP globally, which is about 2%. And it's not like the demographic case is going to change, because selling colostomy bags or wound care or bandages for people such as burn victims is not going to go anyway.
But it looks like it did take a hit sort of late last year.
Yep. And it's just because broker analysts want to see more, and their opinions are still in a negative time frame or outlook. And it's just a matter of, revenues in the last 5 years have grown from 19 billion to 27 billion. So we're getting revenue growth in the 8 to 10% range with the acquisitions included, and the profitability still continues to grow at roughly 10 to 15% a year.
So you think it'll continue to climb back up from that 729 point?
Yeah, it's been up over 1,000 Danish kroner. So at some point, the brokerage analysts are going to see that the turnaround is working, and up she goes. So for us, we've owned it for a long time, and we'll just continue to buy more of it.
Got it. Okay, let's go back to the phone lines. Rob's on the line from Calgary today. Hi, Rob. What's your question?
Thanks for taking my call. I'd like to, or I'd be interested in hearing David's opinion on HSBC. I believe they're going through restructuring, and I'm wondering if this bank is performing to expectations relative to others in the financial sector, be it European or elsewhere, and if there's be an alternative that he might prefer. Thanks again, and have a good afternoon.
Thanks. HSBC, yes. So in Canada, they sold to Royal Bank. Overseas, their focus now is less European, more Asia, more Middle East.
Okay.
To do that, they're laying off a lot of staff. They're trying to reorganize. From a valuation perspective, I'm not a big fan of them because the return on invested capital is at 6%, but the weighted average cost of capital is at 7%. So they're in a negative situation, so they're not allocating the capital appropriately. And what you're getting, you're getting a 5% dividend yield, but the dividend's not growing at speed or pace. So again, long-term performance over 20 years has only been about 6%, compounded annually with dividends reinvested. So it hasn't been a great investment. When we talk about diversification, we own 3 banks around the world instead of 6 Canadian banks and 3 US. We've got Royal Bank for North America, we've got HDFC Bank for India, and we've got Svenska Handelsbanken, a Swedish bank, for Europe.
I don't want to go too much off topic, but why did you pick the bank in India?
With HDFC, where do you want to be for growth? So we want to find countries where the population is, half the population in India is under the age of 35. So there's a lot more potential growth there than aging populated markets of North America, Europe, China, Japan.
Got it.
So that's the reason why we be there, and the way to get into the Indian economy is pretty much through the banking system.
Okay. We do have to take another break. David Driscoll is sticking around to take your questions on global equities. We're back in a moment.
Making sense of business and the economy can be tough. We dig through the details to tell you what you need to know with straight talk and expert analysis so you can make informed decisions about your future.
Taking Stock, Fridays on BNN Bloomberg.
Welcome back. Thanks for joining us here on Market Call. Let's go right to your phone calls. Dominic is on the line from Montreal to ask David a question. Dominic, what's your question today?
Yes, hello. Thanks for taking my call. I'm calling about Ferrari, and I'm wondering, their clientele are much more resilient than the average person. The 8-year chart on this stock looks pretty healthy to me. I'm wondering if I could have David's insights on the company as an investment, their opportunities, challenges, and if you can suggest a good entry point as well as a great price entry point here.
Okay, so it's down to $400, which might be an entry point.
400 euros, down from a high of 492. When you look at the car companies, because I've looked at them before, we will never own them because their capex is well beyond what their free cash flow generation comes from. But when I looked at Mercedes and BMW and Ferrari from a metric standpoint is the winner, because you have people out there in the world that are Ferrari aficionados who will pay the hundreds of thousands of dollars that the cars are going to cost custom designed. Therefore, Ferrari does control output, margins, and pricing power, whereas BMW and Mercedes are more in with the rest of the automotive manufacturers. So you're getting, 18% 5-year dividend growth. The other car companies are barely budging their dividends at all.
It's just a more loyal group to that brand.
Correct. And that's where the premium price is coming from. So in this case, I have no problem if the viewer wants to own it. My suggestion would be buy a half a position. So if you got 10,000 to invest, buy 5,000 worth and see where it goes from there. If the market were to fall apart like we saw in 2011 or 2018, there's an opportunity to do some dollar cost averaging, buy more shares and accumulate over time. Because the way to win in the long run is time and compounding.
Okay, so go in, dip in, and keep your eye on it.
Yep.
Essentially. Okay, let's go back to the phone lines then. Jim is calling us today from Elliott Lake, Ontario. Hi, Jim.
Hi, good afternoon. Just want to ask you about Eli Lilly. I know you touched on it briefly when you were talking about Novo. Listening to your colleagues on here, they tend to lean a little bit more towards Lilly over Novo just because of its more diversified product lines. Just your thoughts on Lilly. Would you hold both? If you did, could this be a good entry point for Lilly? Thank you.
That's a really good question. Would you hold both?
No.
Because
correlation risk is the killer of all retirements. Think of 2008. If you owned all 6 Canadian banks, it wasn't one of them that fell 40%. They all did. So if you had $1 million in retirement and you lost 40% of your investment, you are at risk of running out of money in your retirement. So choose one or the other. Lilly, as the caller said, has more diversified pharmaceutical base, so they're selling other drugs such as oncology, anti-infectives, endocrine, things like that. So they have a more diversified base, but they are more North American or U.S. focused. So, you get 6 of one, half dozen of the other, pretty much. From these two stocks, they're going to move in tandem for the most part, because again, Mounjaro versus Ozempic are going to be big billion-dollar blockbuster drugs for the future, and it's just up to the individual investor to choose one or the other.
Got it. Okay, let's go back to the phone lines. Elliot is on the line today. Elliot's calling us from Hamilton, Ontario. Hi, Elliot. What's your question today?
Good afternoon. With all the cross currents, political and economic south of the border, where does that leave a company like Paychex? And I believe they report this week. Is that correct? Are you still buying shares of PAYX? Thank you.
Well, Paychex doesn't have to worry about tariffs because it's a domestic U.S. company. If Trump were to put through his tax cuts to 15%, then you're basically adding another 20% opportunity to growing earnings. Paychex is an automated payroll processor. They do a lot of HR work with 401k plans, workers' comp, insurance, et cetera. So the margins have been growing over time. They just made an acquisition that is going to be accretive to their earnings. The earnings are supposed to be out March 26th, so tomorrow. The stock's at 143. It's trading at 28 times earnings. It's a little steep, so any corrections they might get in here would be a good entry point. The dividend's been growing around 10% a year, and the yield right now is at 2.7, which is about double what the S&P 500 is. I've owned this stock for over 30 years, and the long-term returns have been in the 14% compounded annual. So you're going to get dips when the economy gets weaker because they service small and medium-sized businesses, which is the heart of the U.S. economy. But one thing which always leaves me befuddled is why Buffett never bought Paychex, because they're a cash cow. They're allowed by law to bank all of the payroll tax remittance over the weekend before they have to remit to the IRS. So interest rates sitting around 4.75% in the U.S. right now. On $4 billion, that's free cash for them. That adds about 3 cents to their earnings.
Interesting little caveat there that they can do that for the weekend.
Yep.
Makes them money. Okay. We do have to take a quick break. When we come back, we'll take a look at our guests' past picks. That's coming up next. back to Market Call. We're going to do a look at the past picks from our guest, David Driscoll, today. The time was July 2nd, 2024, so last July, last summer. And at the time, you had picked Carl Zeiss Meditech, which was at a euro price of 64.90 and now up to 68.80, so a rise of 6% in returns, total return rise of 6%. They make medical technology equipment specifically for ophthalmology.
And lenses for binoculars and lenses for surgeons in hospitals. All three past picks were small caps on the expectation that interest rates U.S. were going to fall. We haven't seen that, so the Russell 2000 index is actually down 6% year to date. So I'm not expecting anything from them, but the three past picks were turnaround plays where the stocks had gone down. They're getting into a range that was very cheap. And for us, it's a good opportunity to dollar cost average, buy more shares. The dividends continue to grow, so there you're getting time and compounding working in your favor. For Carl Zeiss, the stock had peaked in March of 2024 at 120, came down in July. It's up a little bit, but year to date, since the beginning of the year, with the change from risk on to risk off, it's up 51%. So that turnaround is in place. They had fallen because sales to China had weakened because Chinese economy was starting to go down.
Yep.
Now they're spending more money, orders are starting to pick up, and the stock is recovering.
Got it. So you would hold?
We're buying more, actually.
Got it. Okay, let's go to your next pick from last July, which was Enghouse Systems, which at the time was $30.56. And now is dropped to $26.64, so a drop of 13% in returns and a 10% drop for total returns. They do software. Their Canadian company does mapping software.
Yeah, so you can track a delivery of something.
And who doesn't want to track these days, right?
Through their systems. They also work in the telecom and utilities industry for the other side of their business. Here's a company that is a small cap. So 2/3 of the fund managers are not looking at small caps, the mid and the large. It's Canadian. The small cap index is down. People don't want to touch it. And I'm more and more excited about this stock as time goes by.
Why is that?
Well, number one, they've always been a serial acquirer. So they're out there buying businesses of private companies and getting lower prices than you would for public companies. Everything comes into play in the software world. They've gone to a SaaS software, subscription software, just like Microsoft did. The margins are starting to rise, but nobody's paying attention. But they've risen to the point that the dividend went from 26 cents a quarter to 30 cents.
And there's a market for that kind of subscription service here?
Yes,
okay,
definitely. And there's a growing service. They're just not very large and they're not very liquid. But we are buying more at these levels because right now the dividend yield, which is unheard of for a small cap, is at 4.5%.
Got it. Okay, let's get to your last pick before we have to take a break. So again, July of last year was Spectris at pounds, 28.20, up to down to 24.36. So a drop of 14% and then 13% in total return. What happened or what is happening with Spectris?
Well, they make measurement items, so whether it's for water purification, measurement, testing, or groundworks, or food, or anything like that, demand has fallen off to the degree that they've had to do a little bit of restructuring and turnarounds, but the latest acquisitions are paying off, and the dividend is rising yet again. So we're getting a 3.5% yield for a small cap stock out of a British company. British pound against Canadian dollar has gone up. So it helps to offset what's happening with the price.
All right, so you're going to hold it?
We're buying.
You're buying again. Okay. Yeah. We do have to take a quick break. We're going to be back with David Driscoll and get back to your phone calls in a moment. Stay tuned. Welcome back, and thanks for joining us here on Market Call. Let's go right to your phone calls. Mary's on the line from Burlington, Ontario. Mary, what's your question today?
Hi, Marilla. Hi, Dave. Thanks so much for taking my call. I was wondering, David, if you wouldn't mind telling me a bit about Cogeco. I know you've mentioned it in the past, and I think it's kind of an interesting idea. Thanks so much. I'll hang up and listen.
Okay, many moons ago, Rogers tried to buy them, and the family spurned the offer. Stock went up to $100 and then came down into the 50s, and we're sitting around the $67 range now. The reason that they're not getting killed with Rogers, BCE, and TELUS is that they're one of the cable companies that CRTC is helping hop on
other lines.
Yep, other wire lines. And in the United States, they've got their own little pocket of that they're moving to streaming services. So they don't have to spend as much, excuse me, on capital expenditure as the other big boys do.
But this is a fight, right? Like there's a big fight over that. So are they able to do it easily enough, or are they stuck in court somewhere?
Nope, not for the time being, because their U.S. operations are growing faster than the Canadian.
Got it.
But they do have a foothold in Canada at a much cheaper cost of capital than the others do.
Got it.
So the debt doesn't have to be as high as the 20 or 30 billion that the big three spent on 5G and are getting no returns from. So this has allowed them the economical scale to be more of an asset-light telecom, which is favoring them. It also allows them to raise their dividend by 10% a year, which Rogers hasn't touched their dividend for a number of years, especially given the Shaw acquisition. Really added a lot of leverage to the balance sheet. So this is just, you're in the telecom sector, you're getting a 5.5% yield. If you want to make a 10% total return, all you need is for the stock price to go up $1, and you're there.
Got it. Okay.
So you're getting low risk because the beta is only 0.68. So when the market goes up or down $1, with Cogeco, you're going up or down 68 cents. So the lower the volatility, the better. Because if you have high volatility like the artificial intelligence stocks, then you're going to be whipsawing in your portfolio that at the end of the day may turn out to not be good for you.
Yeah, heart palpitations for sure. Okay, let's go back to the phone line. John is calling from London, Ontario with a question. Hi, John.
Hi, Marilla. Hello, David. My question is on Netflix. They seem to be doing a lot of good things. They were impervious to early COVID, and the stock price went up. They had a drop in 2022, but since then have had a beautiful rise. They buy back shares. They don't pay a dividend yet, but they're the king of streaming. So it fits your thesis on pick the best. What do you think of Netflix? I've held it for 4 years. What about an ad here? Thank you.
Let me ask you something, because Netflix, of course, was first out the gate with this kind of thing so many years ago, and then everybody jumped on, and there's been success for some of the other streaming services. Well, what does Netflix have? What is it doing that perhaps some of the other companies are not, that has given it this long-term ability to build?
Their library. And that's what has been successful, because most people may have a few streaming services, but Netflix tends to be the first one that they're going to choose. As far as owning the stock, because it doesn't pay a dividend, you have to be very disciplined. So again, we go back to, if you double your money, sell half, because the volatility is such that any bad news could send the stock down quite a bit.
So basically the rule of thumb is if you double it and they're not paying a dividend, then you sell half.
Yep, because think of Meta. It was up 100% in 2021 and then fell 70% in 2022. So you go from $1 to $2 to 60 cents. So this is where the risks come into play, and to offset that high beta name with lots of volatility, the way to offset that is when you double your money, sell half.
Got it. Okay, let's go back to the phone lines. Gordy is on the line calling from Surrey, BC. Gordy, what's your question?
My question is on Parkland. They've been a little bit of talk about them lately. I'm just wondering how they're going to do in the next couple of years.
So really interesting situation with Parkland.
Yeah, well, the clashes in the boardroom are just legendary now, because it's been ongoing for the better part of 5 years, if not more.
Yeah.
So again, you've got gas stations and refineries, and I think what the controlling shareholder wants to do right now is sell the gas stations, keep the refineries where the margins are higher, and you don't have to deal with the volatility of movements in gas prices. and they've got lots of real estate sitting on those gas stations. We don't own the stock, we own the bonds.
Okay.
So, we've been getting paid 6% pretty much for the last 5 years at a time when interest rates are falling. And because they're not investment grade, their maturities are 5 years or less. So as long as they keep the cash flowing in, then it's the bonds will do well. As far as stock's concerned, it's up 12% year to date because of all the chatter that's going on.
I was going to say, do you see the mix-up as a good thing down the road for this company?
It depends if we can get some kind of resolution built out. Are you going to keep the gas stations? Or are you going to get rid of them? If you get rid of them and spin them off, then I could see the refinery business continuing to grow, not at a huge rate, but it could unleash some value just because you're getting rid of gas stations which aren't doing all that well.
But the detractors still have to detract in the interim time. That fight is not over.
No, the fight's not over, and because they are not investment grade bonds, the leverage is high on the company too. So that's another risk for shareholders.
Let's go back to the phone lines. We have Tom on the line from Kingston, Ontario. Tom, what's your question today for David?
Yes, good afternoon, Marilla and David. Thank you for taking the call. What I was wondering about is there's a lot, I'm looking at the defense companies in Europe. Some of them, like Rheinmetall, have done extremely well. I'm wondering if you have one particularly that you would like out of the group. And also, I'm wondering, sort of a secondary to that, would you think it's better to buy the stock on the European market or buy the ADR here in North America? Thank you.
So even the announcement today by Mark Carney that he wants to beef up the military in Canada, defense seems to be a growing industry moving forward for obvious reasons.
We have a company in Canada that fits that bill, which is CAE, because they're not just simulators for commercial airplanes. They're also simulators for the fighter planes as well. So from an ethics standpoint, that kind of gets you away from the guns and ammunition that the Rheinmetalls in Europe are dealing with. So that's the way we're playing it. We also have another company in the United States called HEICO out of Hollywood, Florida. Its biggest competition would be Boeing, where they're benefiting from the fact that Boeing's accident rate continues to rise.
And do they do the same thing?
They are OEM parts for the commercial aircraft. They also have an electronics division that has military contracts with the U.S., and CAE does as well with the U.S. military.
Do you know the stock symbol?
HEICO. It's Henry Edward Igloo on the United States.
Henry Edward Igloo.
HEI.
Okay, we'll pull that up in a second and see if we can find it.
Yeah. Second question was ADRs versus the home shares. We always buy off the foreign exchanges because the liquidity is greater than the ADRs, because the bid-offer spreads tend to be narrower, so you can get a better price, and the ADRs can have all kinds of different fees and taxes that are charged by the NYSE or whoever issues the ADRs. So we're loath to buy ADRs. We'd rather buy off the foreign exchange, and then you get a foreign currency to help offset the Canadian dollar.
Got it. Okay, we're going to take a quick break. We will be back with more of your phone calls in a moment. David Driscoll taking your calls today on global equities. Stay tuned. Welcome back, and thanks for joining us today. We want to get back to your phone calls. Sal's been holding on the line from Toronto. He has a question today for David. Sal, what is your question today?
Thanks so much. Yeah, my question's on Rheinmetall. It's in part of the defense sector. I was wondering, I know there's been a massive run-up in this company. Do you think there's still some point in adding to a position here, or do you think it's better to wait until maybe some of the hype blows off? And then the second part to that is there seems to be a growing boycott U.S. type movement. I've been seeing that online, and I'm seeing conversations through our allies as well. And so I was wondering, do you see some risk to U.S. stocks based on this growing type movement? Thanks so much.
It's kind of been going that way more in just the product and services line. Is it going that way in the stock markets as well, you see?
Yeah, Rheinmetall, don't forget, it's only about 20% defense. They've got a lot of other stuff going on in the group. So you're getting, as the caller suggested, you're getting a lot of movement upwards in the stock price just because anything that's called defense in Europe
is moving.
So Rheinmetall's up 113% this year.
Wow.
And the European stock market is up, where are we? 11. Okay. So you can see the difference where hype can, here we go with the momentum train yet again.
Well, Europe hasn't been a target of Donald Trump yet, right? He's been focused very much on Mexico and Canada, so.
Yeah. So what we're doing is we've always been diversified globally. So if we have a 30 stock portfolio, as an example, we'd have 4 Canadian, 13 US, 13 international. But because all the portfolios are customized, the client can say, but I don't want any US exposure. Great, we can do that. So we can give you Canadian, international. With the US stocks, a lot of the ones that we own are domestic, so that they're not going to be involved in trade wars per se. They will probably face inflation if tariffs go up and costs go up and inflation goes up, but they are domestic. And they would be the biggest benefactors of any tax cuts that Trump were to put through. In the meantime, you're getting Europe and emerging markets going up while the US markets are going down. So you're getting it based on valuations, because a year ago, Europe was trading about half what the value of the S&P was, emerging markets even more. And emerging markets, because a lot of their debt is denominated in US dollars, are at the whim of the US dollars. So this year, the US dollar has dropped 4%. The emerging markets are up close to 7 or 8. So they're kind of reciprocal in that regard, because for the last 10 years, the US dollar has gone up and the emerging market stocks have not performed. They've underperformed. So a year ago, I was saying that I thought the emerging market stocks were cheap, and now we're getting the benefit of that. So as far as US is concerned, you can hold US stocks that are mostly domestic, and then enjoy the rest of the world, because there's only 400 million people in the United States, 7.5 billion people outside. I'm sure Europe and other countries, even including Canada, can find other trade partners and avoid the tariffs.
Got it. Okay, let's go back to the phone lines. Gulam is on the line from Toronto. Gulam, what's your question today?
Hi, my question is on 2 ETFs, SOXX and ZQQ. ZQQ seems to be doing okay, but SOXX seems to be going down. I don't know why. But can you tell me whether I should keep holding on to it? Do you see much upside on those 2 ETFs? I'd appreciate your opinion. Thank you so much.
Thanks for calling.
Well, both are tech sectors. So you've had the run up the last 2 years. Now you're getting the flip side, because if we're going into more diversification and risk off, these ETFs are not going to perform very well, because if you get inflation with tariffs and higher interest rates, we could get another 2022 type situation where the growth stocks, the small caps, all sell off, where NASDAQ was down 35 and the S&P was down 24. So don't own both. If you want to own one, just make sure that you manage the percentage that you have with your other ETFs and be diversified that way. In the ETF world, all you need is 1 Canada, 1 US, 1 international, and an international bond ETF, and you're all done.
Okay, let's get one more caller then before we have to take a break. Anita's on the line from Markham, Ontario. Anita, what is your question?
Good afternoon. Thank you for taking my call. David, I don't have much exposure to the international market than U.S., so I was wondering if you could recommend an ETF or 2 ETFs that would cover the big caps of Japan and Europe. I'll hang up and listen to you. Thank you.
Yeah, MSCI has an ETF that is international ex-US. So I don't know what the ticker symbol is, because I don't deal in ETFs. But I'm sure if you Googled that, you'd probably find one. And you don't need 2. 1 will do you well enough, because there'll be enough Japanese and European exposure in that ETF.
Got it. Okay, we do have to take a quick break. When we come back, we'll have David's top picks, so stay tuned for that. Back in a moment. All right, time now for top picks with David Driscoll. His first forward-looking pick is Chubb on the New York, Stock Exchange, an insurer company. Why do you like Chubb?
It's a very defensive stock in this kind of environment, that if we go to risk off, insurance pricing has not slowed down because of all the catastrophes that are going on. And as a reinsurance company, they'll take a 10% hit on the catastrophes, but they'll insure themselves for the other 90%. Their combined ratio is about 84%, which means that for every dollar of policy they're writing, they're paying out 84 cents. The difference of 16 cents is what they get to invest. This is why Warren Buffett loves insurance companies. What I like about them is that they're not using that investment income in equities, they're using it in bonds. So if we do get a correction to some degree because of all the tariffs and all the geopolitical risks that are out there, they should be able to hold their own, grow the dividend, and a lot of their bonds are 1 to 5 years. So if interest rates are cut in the United States, they'll be a benefactor of that. Got it. Okay, so let's get to your top pick number 2, which is TC Energy, which we do get a lot of questions on. TC, of course, trades on the TSX, an energy infrastructure company, natural gas pipelines and power plants. Why this particular company? Well, don't forget, they also have nuclear power investments as well with the Bruce plant. Oh, look, we're at a new high today at 70.97. Again, defensive, you're getting 4.8% yield. Natural gas is in demand and will continue to be in demand. They don't have to worry to a huge degree about tariffs because they're in Canada, the US, Mexico. They've got nuclear power if need be, because if these tech companies want to build all these data centers, they're going to need power. But if they're exporting power across the border, aren't they going to be hit by that 10% tariff? Yeah, we'll see about that. So you don't actually think it's going to be a big tariff or won't continue? Well, they can raise prices themselves. They also have domestic pipelines in the United States, so they don't have to worry about tariffs on that part of the line either. Okay, so but they will have to worry about what's coming out of Canada and perhaps going south. Perhaps. Got it. Okay, let's go to your third pick then, which is Lagercrantz Group out of Sweden, you had said. Tell me about them. They're a small cap company, so out of Sweden that acquires, so they're a serial acquirer. They make 4 or 5 acquisitions every year of private companies at very cheap prices, roll them into the company, and what you can see is long-term growth rates that are pretty significant. What are the kinds of companies they acquire? Oh, they're right across the map. They can be scientific, they can be automotive. And these are smaller companies? Alarms, control equipment, sprinklers, fire protection, valves, washing systems for heavy vehicles. They're in hospitals, land-based fish farms, refrigeration rooms. So okay, so they're across the gamut. And how are they making money? Are there more efficiencies when they're running a number of small companies? When you buy a small company and allocate your capital with the expectation of getting higher margin businesses over time, rolling them up just continues that you're getting not just organic growth that is 2 or 3 times higher than GDP, but then you get the acquisitive growth on that. Higher revenues, higher margins, results in higher profitability. And as a result, as the profits rise, ultimately the share prices will follow. And you're getting a dividend increase close to 20% a year. Wow. Okay. So there's one solid reason to buy anyway, just because their dividends are going up that much. And also against Canadian dollar, the Swedish krona is up 10% this year. So you're getting currency protection in that regard as well. Got it. Okay. So that's your third pick for the day. I want to circle back to the conversation we had at the top of the show, talking about how people are more worried about risk these days than they have been in the past couple of years. We saw all of the tech stocks, of course, take a bit of a beating in the start of the year. There's been a bit of a bounce back, not so much. Okay. I'm just wondering what you see with the April 2nd deadline for the tariffs. That still sort of overhangs the market. Well, that's where the diversification comes into play, because we're up and the market is down this year. So this also happened in 2011 and 2018. It's currency diversification, it's diversification by companies, by countries, by size of company, that allows us to hold value while other things are getting hit or valuations are coming down. Ours continue to grow because of generating free cash flow. And then as far as emotions are concerned, left brain has to dominate right brain. Because when you're investing, left brain is logic, math, and reality. Right brain is fantasy, unicorns, rainbows, emotions. You gotta leave your emotions at the door. Your left brain, if you start to get excited, because we've been through stuff like this before, 2018, where Trump trade wars with China, same thing was happening. Left brain has to tell right brain, chill. Okay. So stay focused on your investments and let them grow. And as the dividends pay out, then you can take that cash. If the market's down, you can dollar cost average And then in 10 or 20 years, you should be able to look back and say, well, acting on emotion is really a dumb thing.
Very quickly, I just wondered, people do want to take advantage of the lower cost right now. Where would you dip in if you were going to dip in?
Well, we're right across the board. Okay. So we're looking at any of our stocks that are less than the 3% weight, because there's 30 stocks, the average weight's 3.3, and just every month be buying a little bit of them over time.
Steady as she goes. Dave Driscoll, thanks for coming in. Appreciate your time on this.
You're very welcome, Marilla.
We are going to take a break and say goodbye here on Market Call. A look at the markets as we do that. We'll see you again tomorrow.